I smell money.
$6 billion! We are back all the way!
Where the is Taylor?
You can make more than you do now with a partnership stake.
Anything I do to stop you is warranted.
How easy is it to start your own hedge fund? Well, we will discuss how to start your own hedge fund and much more as we analyze Billions Season 3, Episode 12, based on my work experience at the top hedge funds in the world, my work experience starting a hedge fund, and my work experience at Goldman Sachs. Now, please like, comment, and subscribe, and stick around, because at the end of this video, we will grade the episode for Wall Street Realism with a buy, hold, or sell rating.
Why are you leaving X? After all, he made you.
The same reason you leave a house that has a furnace leaking carbon monoxide. It's the only way to survive.
Now, Axe Capital's star portfolio manager Taylor quit to start a hedge fund, and starting your own business is the only way to live your life in your own terms, especially since your boss can fire you at any time if your performance sucks, or even worse, if you're too good at what you do. Now, when raising money for a startup, confidence leads to perceived competence when it comes to meeting with investors.
So instead, I'll tell you that my anticipation and my reaction to moment-by-moment changes in market conditions are lightning quick. And cutting-edge tech, a quant piece that wasn't even in place during the past year that reflects my already positive results.
So often the best entrepreneurs and hedge fund managers are incredibly unemotional. And you gotta be this way. Be a contrarian and watch your net worth take off. And as Warren Buffett said, the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale.
They're not buying your proprietary trading platform. They're not buying your strategies. They're buying you. Remind them that we have the answers, that they are safe in your loving arms.
Accurate. Sophisticated investors invest in people first and the company second, as the jockey's always more important than the horse. Now, in addition to making clients money, capital preservation is key, especially in down markets. Now, why is it called a hedge fund? Well, I want you to think of your backyard. You have a hedge around it to protect it, kind of like a moat. And many hedge funds focus on capital preservation first, and then making a lot of money second.
Over the past year, we've seen the lowest market correlation of any fund in the business.
So investors often ask, what was your performance in massive down months, like in Q1 of 2020 or in the fall of 2008? So try your best to never have more than a down 5% month, and you can use options to do this. Now, in addition to options, what risk management metrics should you use in order to manage your portfolio in order to ensure that you don't have massive down months? Well, you want to try to make position sizes, if there are non-ETFs, a maximum of 5% each. Also, ensure that no more than 20% of your portfolio is in any one particular sector, like tech, retail, healthcare, industrials, financials, etc. And only invest in liquid stocks because illiquid stocks own you in a down market. And you want to do deep research and try to invest for the long term in 5x5s. What does that mean? That means a 500% return within 5 years. So how do you do this? Well, you create an in-depth financial model and base your target price and your investment thesis on your 5-year earnings estimates per my methodology here. Now, what else do investors look for?
There are only two things these allocators really want to know, but they'll never directly ask. Can we be trusted? And are we special? We nailed those, we nailed this entire thing.
That's accurate. Transparency builds trust, and investors want visibility in terms of how their investment is doing. So here is what Axe Capital proposes when trying to raise money from investors.
Come sit in and shadow me for a day. It's grinding, focused work. It's sitting on their bed for weeks, months at a time, working slip cuts, perfecting the Elmsley count so that the audience never sees where the cards really are.
So Taylor's confidence and body language is impeccable in terms of eye contact and so much more. Now, ideas are commodities, but execution is not, and Axe markets the crap out of Taylor to investors.
Taylor is the single most effective manager of money I have ever come across. They are the future of Axe Capital, and I'm just thrilled that you're all going to get the opportunity to work with them directly alongside me and the team.
Sophisticated asset allocators do deep due diligence to ensure that hedge funds have a deep bench with the best portfolio managers, but this happens.
I've been making follow-up calls to book the money that was pledged at the raise. I'm having problems locking it in.
What problems?
Problems reaching people. They're dodging.
Where the is Taylor? They're here before me most of the time.
Now, before you quit your job to start your own company, of course, please hire a lawyer to read the contract and potential NDA that you signed with your current employer. Now, what's unrealistic about this episode is that Taylor quit and gets multiple Axe Capital investors as clients. The reality is, you can't do this as it's a breach of contract. In fact, at some top hedge funds, if you quit, you legally have to wait 1 year before starting a hedge fund, which is not really enforced in the state of California, but every other state it most likely is. Now, to make matters worse, Taylor poached Axe's favorite trader.
No Mafia today.
A new kind of organization, top down, and you can make more than you do now with a partnership stake.
When?
Now.
Now, if you're given an offer to join any startup, always ask for more cash, meaning salary, than equity or shares, because it costs the company nothing to make more shares, as this is a non-cash expense. Now, of course, say that you want some equity or stock options, as you don't want to come across as a flight risk. But the reality is that the equity contract you sign locks you up for years, and it can be at the full discretion of the owner of the company if you could ever cash in your equity. Now, Axe here consults with his lawyer.
Is there anything I can do to stop Taylor from officially opening?
We won't win fast enough to injunct them from opening.
File anyway. Let's get Taylor distracted from the bottom line. Let's see how they do with split focus.
Accurate. Accurate in that most startups fail because of distractions. Yes, you might be very good in the company you work at now doing skill X, but all the administrative crap like operations, is the printer working, payroll, etc., are taken care of by administrative staff. So although you're very good at skill X, when you start your company, you need to make sure to outsource all the operations stuff. And this is one reason why most hedge fund startups don't make it, and why 99% of the investments from the top 10 venture capital firms are not unicorns. Now, the first clip I showed you today was Axe celebrating that investors committed to invest $6 billion in Axe Capital. The reality is, always cut that number in half, as many investors decide not to invest at the last second.
As for the cash, $500 million came on board, $3.5 billion went with Taylor, the other $2 billion pulled back, went elsewhere, didn't want to be involved in a family fight.
Now, if there's any hair on a startup or an established firm's pitch, investors run for the exits. And Taylor getting $3.5 billion is a far-fetched, but many of the top hedge fund managers got their start by working for others, and you need to do this in order to build a track record. And the best example of this, and the best hedge funds to work at, are billionaires that started their careers working for Julian Robertson at Tiger. This is important. Julian Robertson was known for deep fundamental research and long-term investing. It's the only way. And Julian Robertson's Tiger management became the greatest hedge fund talent factory ever, generating roughly 32% in annual returns for nearly 2 decades. And a lot of Tiger Cubs came out of Tiger after building their track records, including Stephen Mandel's Lone Pine Capital, Ole Andreas Halverson's Viking Global Investors, and Chase Coleman's Tiger Global Management. And other major Tiger Cubs included Lee Ainsley's Maverick Capital, John Griffin's Blue Ridge Capital, Philippe Lafont, who I've met, Coutu Capital, I almost worked for him when he started it, and Bill Huang's Archegos Capital Management. And the Tiger Cub network became so influential that more than 200 hedge funds eventually traced their roots back to Tiger management. And so start your hedge fund career working for a Tiger Cub, build your track record, and then launch your hedge fund. So what is Axe going to do about Taylor quitting? Well, here he meets with a corrupt Russian billionaire and Axe Capital investor.
If I promise you that I will make your problem disappear, your problem will never ever return.
I can't allow Mr. Axel.
Shut up.
This is great drama, but this doesn't happen. John Malkovich, the actor playing Grigor, lost a lot of money with the real-life corrupt Bernard Madoff, which is one reason why he took the role. And I always knew that Madoff was corrupt because his name is Madoff, because, you know, he made off. Sorry, terrible dad humor. Now, how is Axe going to deal with Taylor, though?
You've stolen from me under false pretenses, and you've betrayed me.
I did what I had to do to survive and to win. You've got to understand that. I did it for me, not against you.
Now, Taylor's strategy and thoughts are accurate. Many hedge fund PMs feel like they're surrounded by sharks, and many of them list the movie Highlander as their favorite movie, as there can only be one winner.
Congratulations. Now you have your own shop, billions under management. You're moving even quicker than I did.
Yes, I'll surpass your assets under management at the rate I calculate in 3 years at the earliest, 8 at the latest.
So nobody seems happy in hedge funds, as they always compare themselves to those that make more, and enough is never enough. And this is why you see some billionaires get arrested for insider information. And you ask yourself, why would they break the law if they're already billionaires? Because being unethical for the minority of hedge fund billionaires is how they got there. Enough is never enough.
You have to know that anything I do to stop you is warranted.
I anticipated that being your reaction. So do what you must, and I'll defend as I have to.
Now the acting is incredible, eh? Now, smart hedge fund billionaires invest in former employees' startup hedge funds, and then they piggyback on their trades. And Julian Robertson became very famous for reacting positively when top employees left to start hedge funds, often mentoring them and investing seed capital in their new firms and helping create the legendary Tiger Cub network that later dominated the hedge fund industry. Now, hedge funds I've worked at also had on-site psychiatrists like Wendy right here. And this is something that Julian Robertson pioneered. And you need a life coach if you want to stay focused and unemotional. And if you want to work with me, go to this link here you see. That's also in my description of this video to set up a call with my team. Now, Taylor knows how important a coach is as Taylor tries to recruit Axis coach Wendy.
What do you want?
You. I'm building, not destroying. That's where you come in. I'm assembling a place that's tech-centric, but I want my people as frequently tuned and upgraded as the software.
Now, Wendy sees Taylor's youth as a risk, given the lack of experience. Now, please work for a top hedge fund for at least 3 to 5 years before launching your own fund. Let's discuss how to raise money for a hedge fund in more detail. In this next clip, Axe talks to a potential investor.
Do this for me and I'll cut your fees to 1 in 10 over the next 3 quarters.
Now, when you get your first investor, you might have to give them reduced fees. And here Axe tries to convince the investor here by offering him reduced fees in Axe Capital by paying 1 in 10 instead of Axe's usual 3 and 30. Now, what 1 in 10 means is Axe will let the investor only pay a 1% annual management fee and a 10% incentive fee. For example, if this investor invested $100 million in Axe Capital, then he would only pay a 1% annual management fee, meaning $1 million. And if Axe Capital makes money, the investor will only pay a 10% fee. So for example, if the investor's $100 million doubles, then he would only pay a 10% incentive fee, meaning $10 million of the $100 million increase in his account in Axe Capital. And although the going rate for hedge funds is a fee structure of 2 in 20, startup hedge funds often charge closer to 1 in 20 in order to entice new investors at launch. Also, large early investors often get part of the management company, meaning they might own 25% of the hedge fund so they can make money on fees. Now, here are 10 tips on how to start a hedge fund, and many of these tips will help you starting any startup. Number 1, you need to show investors a track record of performance by either working at another hedge fund or managing your own money in an audited account. Tip number 2. If you don't have a long track record, then don't waste your time talking to big institutional investors like pension funds or endowments. Why? Because you'll get meetings if you try hard, but they're not going to invest with you until you've been running your own hedge fund for a few years. Now, who should you meet with? Well, when you start any company, you want to meet with high net worth investors because the sales cycle is shorter, and you always want to talk to the decision maker, meaning the wealthy person with the capital. So how do you even get meetings with high net worth investors? Well, step 1, have an amazing LinkedIn profile, which I teach in my consulting services. Step 2, do an advanced search in LinkedIn and find at least 2 things you have in common with this person, because relationships are often more important than product knowledge, and your network is your net worth. Step 3, send an in-mail and not an email, because everybody reads in-mails. And I want you to type this in your in-mail, for example. John, hope all is well. I also went to the Toronto French School, and I also live in the Bay Area. Please let me know if you have time for a coffee or a Zoom call. Thanks a lot, Chris. Now, you never want to write why you want to meet, or they won't respond. Now, one meeting can change your life, and you might be thinking, hey, why would they take a meeting with me? Well, I want you to close your eyes and imagine this, okay? In 20 years, you're way more successful than you already are today. If somebody 20 years younger than you that reminds you of yourself asked you for a meeting, would you take that meeting? Of course you would. please remember that closed mouths don't get fed. Now that you have that meeting set up, what do you do next? Well, step 4, in your meeting, you bond before business. And you want to bond for the first 10 minutes of the meeting and talk about what you have in common, or better yet, go to their X or Instagram profile and see who they follow. If they follow baseball players, talk about baseball, as sports is great boardroom talk. Now, step 5, in the meeting, pivot to talk about your hedge fund and pull out your investor slides. And regardless of what company you start, your slide should be only 10 to 12 slides with no more than 3 bullet points per slide. And you can use the Airbnb pitch deck template you see right here as it works. I'll include that in the link in the description too. And as you can see right here, they use images and about 3 bullets or images max per slide. Now, in addition to talking about your performance metrics, in the slides, you want to mention risk management metrics that you adhere to. For example, you focus on capital preservation as you run market neutral, which many hedge funds do, meaning you won't be more than 10% long or short in your portfolio. And other risk management metrics you can mention are that perhaps no position will be more than 5% of capital, you have stop losses, and you won't have more than 20% of capital in any one sector. And in your slides, you want to show your infrastructure too, like who's your prime broker, custodian, auditor, your employees, and other service providers, including your lawyer. Tip number 3 of 10 for starting a hedge fund. Never raise capital without getting a lawyer to register your company name. Now, your lawyer will also review your slides and create an investor offering memorandum that details the risk so you're protected. Never invest in anything unless you get an investor offering memorandum, kind of like this Facebook IPO S1 from 2012. Now, the lawyer is also going to create what are called subdocuments, which all hedge fund investors must complete. And these subdocs are like 10 to 20 pages, and they ensure that the investor is accredited, meaning they have a certain liquid net worth, and there are AML, meaning anti-money laundering rules post 9/11, that are also included in this subdocs questionnaire document. And the lawyer will also make sure that you're compliant with FINRA and that you take the appropriate securities exams. Tip number 4, you want to show investors that you have a process for picking stocks. And I've humbly raised and managed over $1 billion, and I'm going to show you what worked for me when I started my hedge fund and venture capital firms. So right here is my investment process. And I used to bring something like this to my investor meetings, which I now give to my clients. And as you can see here, I have a 100-step research process where I analyze qualitative research steps, quantitative research steps, and financial model steps. And in this spreadsheet, you answer more than 700 questions, and you can create your financial model from scratch using this document and show your investors this in your meetings. Now, the outputs here are as follows from this document. Number 1, a dashboard, and all this here is dummy data. The second output is a 100-page thorough investment research report. And the third output is a 1-page write-up, like an executive summary, that highlights the fundamentals, valuation, and technical analysis, all based on the questions you answered in this spreadsheet. And you can print this 1-pager and even put it on the back of your resume if you're interviewing to work at a hedge fund. And each tab has a YouTube video explaining each of the 100 steps. Tip number 5, don't just focus on US investors, go global. How? Now, through your lawyer, what you can do is you can set up an offshore bank in the BVI, meaning British Virgin Islands, and not the Cayman Islands, as BVI is cheaper. That's what I did. And your offshore bank is where international investors want to invest so they aren't subject to US taxes, and never give tax advice though. Now, the process of having an onshore vehicle for domestic investors and an offshore vehicle for international investors is called a master feeder structure, as the offshore bank and the onshore fund feed into your management company, which is often an LLC, meaning limited liability company. And your lawyer might tell you that you can bill your legal fees to your investors over 60 months, meaning 5 years. Tip number 6, what if you don't have enough savings to start your hedge fund? Well, as we saw with this investor right here, you can offer a sweetheart of a deal to your first large investor and give them 25% of your management company, meaning your LLC. And in return, they pay your salary and your team's salaries and other expenses. Tip number 7, it's very competitive to start a hedge fund. So you might have to offer lower fees when you start, like 1 in 10 or 1.5 in 20. Tip number 8 of 10, failing to plan is planning to fail. So please make sure you write a thorough business plan before you start any company, and I have templates for that as well. Tip number 9, be controversial but tasteful so you get free media attention and you're interviewed by top publications. Now, have you ever seen a Tesla commercial? Neither have I. Now, investors like Cathie Woods, who typically underperforms the S&P 500, but investors like Cathie Woods and other financial experts have gotten a lot of free publicity by leveraging the media, which means fund inflows. And even Sir Richard Branson was controversial when he drove his tank through Times Square when he declared war on Coca-Cola with his Virgin Cola product. And Mark Benioff, who founded Salesforce, got so much free media attention because he said traditional software is dead and cloud computing is the future when he launched Salesforce.com after he left Oracle in 1999. And lastly, tip number 10, you need to develop superb sales and presentation skills to raise capital, like we discussed in my recap of Billions Season 1, Episode 6, when we discussed how Bobby and Warren Buffett communicate. Hold on a second. You might be thinking, yeah, right, Chris. How am I going to get media attention? Well, here's how. What I want you to do is I want you to write one article per week on investing or whatever you're passionate about on LinkedIn. Then what you're going to do is after 1 to 2 years of doing this, take all your articles and put them into a book. And you can self-publish for free. And this is exactly what I did. And in the description of this video is the link to download this 6-inch by 9-inch template for the book for free, which includes 1 page of instructions. Now, what chapters do you put first in your book? Well, the ones that got the most views and comments on LinkedIn. Then bring this book to your investor meetings or any networking meeting. And if you think that this is too much work, then I ask you this, and I say this with love in my heart. How badly do you want this job or that investor? Now, it's a marathon and not a sprint, because you don't give up after writing a few articles because your competition will. And as Warren Buffett said, the longer the view, the wiser the intention. Oh my God, I talk a lot. But let's get back to Bobby Axelrod and another group of his employees that quit to start their own firm and what Bobby does as a large investor in their fund.
Here's what I'm prepared to do. We will enter into a revenue share agreement. The current rate for seed money is 20 to 25%, so why don't we call it 40?
40?
Swallow that.
Brutal. Now, earlier I managed selling 25% of the management company when starting a fund in order to get cash flow to pay the bills. But Axe gets 40% of the management company. And this means that if the fund charges 2 and 20, he gets 40% of the 2 and 20.
You will provide total transparency. I want your trade file sent to my office every night.
Now, this is accurate only because billionaire hedge fund managers invest in many hedge fund startups as a way to get information on their trades. But it gets worse.
There will be a limit on how much outside capital you can raise. At no time can you manage more than $999 million.
Now, having $1 billion or more in assets is really prestigious, like owning a restaurant or a vineyard for hedge fund managers. So keeping that under $1 billion in assets is a tough blow for this startup, but wait, there's more.
There will be no buyout to eliminate the revenue share agreement and no lockup on my money. I can pull the plug at any time.
So he's relentless, like a pit bull on a pork chop. But what he means by no lockup on his money is that hedge funds usually require advance notice of at least 30 days before you can redeem your money as an investor. Why at least 30 days? So you don't drag down the value of the longs and vice versa with the shorts, assuming you're only investing in liquid securities. And illiquid stocks, we know, own you in a down market rather than vice versa. Let's talk about raising money in more detail. Now, recall earlier in season 3, billionaire hedge fund manager Bobby Axelrod wanted to raise $20 billion in 6 months, and a lot of that from the Russian Mafia. But he first meets with his prime broker.
What goods or services can I and Spartan Knives provide?
For years, as our prime, you've touted your connections and offered capital introductions, and we've accepted and said thanks. But really,
we didn't need you to generate those leads.
Accurate. A prime broker is like a retail stock market broker, but for hedge funds. They also process your longs and shorts, and they often promise to help you raise capital, but they usually suck at that. Now, the easiest way to raise money is from high net worth investors as the sales cycle is quite short. So how is Axe going to raise, or how was he going to raise $20 billion in less than 6 months?
We need Grigor Handalov.
Guy's a Siberian brown bear.
Maybe I'm not convinced you got your edge back. Or maybe I am, and I just want to see you work a little bit harder for it.
No one works harder than me.
So Axe is desperate to raise money fast, which is why he's speaking with Grigor, who we know is a corrupt Russian billionaire. Now, if Axe accepted capital today from a sanctioned Russian oligarch like Grigor, he could violate U.S. sanctions and face legal consequences, since U.S. persons are prohibited from doing business with sanctioned Russian individuals. And as I mentioned earlier, when hedge funds raise money, they have to complete subscription documents, meaning investors do. Now, these AML provisions were put in place post 9/11 as corrupt hedge funds made a fortune buying puts on U.S. airlines right before 9/11. In fact, the put volume on the major U.S. airlines was at an all-time high right before 9/11. And this means that some bastards made money on the attack on America. Now, recall that Axe made a fortune shorting stocks before 9/11, as this reporter mentions.
September 11, 2001. A plane crashes into the North Tower. Everyone you work with is dead, while you sit back in your chair with a smile on your face, making hundreds of millions of dollars.
And given all the negative press on Axe over the years, he realizes that the only way to raise money is by compromising his safety with a single corrupt Russian oligarch.
You're scared. You don't want to do business with me.
I wouldn't have invited you here if that were the case.
Is that some piss running down your leg?
Now, a bad investor is worse than a bad marriage, because in a bad marriage, people get divorced. But it can be almost impossible to get a bad investor off your board if you're a startup and they buy equity from you. So how can you spot a bad investor? Well, I worked in a hedge fund, very large hedge fund once, and my boss hired 25-year former CIA and FBI agents to help me identify 4 ways to tell if somebody might be lying. And this really helped us with short ideas. So here's how you can use this in all aspects of your life. A liar, number 1, a liar rambles on and on and on to a single yes or no question. Number 2, a liar breaks eye contact more than usual when they're lying. Number 3, a liar touches their face more often than usual when they're lying. And number 4, a liar often shakes their leg more often when they're lying, and this can be what a lie detector test can look for. Now, the 4 aforementioned rules are very subjective and not always accurate, but try it out in life. I promise you, it will save you a lot of heartache. Now, what makes a good salesperson?
In a year's time, you're not going to be able to get me on the phone. I'm about to go on the run of a lifetime. I am aligned. I feel it. And I know you can see it.
So a good salesperson is confident in their delivery because confident leads to perceived confidence. Now, how do you boost your confidence before a meeting or a presentation? Well, you get rid of your imposter syndrome. How do you do this? Well, it's kind of like the Rodin sculpture, I think, therefore I am. Now, here's a very quick exercise that I think will help you boost your confidence forever. And this works in interviews, meetings, and when dating. So this here is the most important chart you'll ever see, okay? This axis is your age, and this axis is give a darn. When you're younger, you're down here, you have meltdowns in restaurants, you don't care what people think. When you're older, you're over here, old people don't have confidence problems, you don't give a damn. Problem is when you're teenagers, 20s, 30s, 40s, I'm 54, but a man-child, you're up here, okay, in your 20s, 30s, 40s, whatever. And you got to eliminate this triangle of despair at all costs. You got to live your life at this level and don't give a that's right, what people think of you, okay? And the most successful entrepreneurs in the world, you know, Oprah Winfrey, Steve Jobs, etc., live at that level. So how do you live at that level? Well, I want you to get a pen, and if you meet me in real life, I'm a tiny man. No more bad dad humor, I promise. But I want you to get a pen and a piece of paper, and I want you to write this down 10 times. Please do this. It's life-changing. I want you to write down, I don't care what people think of X. Do that 10 times. And fill in the blank for X. I don't care what people think of my hair, which I've been dyeing since my 20s. I don't care what people think of the size of my nose, which is ginormous, but it's great when I ski because I can kick anyone's butt because it's aerodynamic. I don't care that people find out that when GTA 6 comes out in November, if ever, you ain't gonna see me for a month because I'm gonna be playing the whole time. I don't care. Tell yourself that. I'm not saying be rude or disingenuous, but just be you. Now, confidence is everything in business.
I'm here, but in 10 seconds, the bullet train leaves. And if you want to make money, climb board.
So when selling, what else can be important from a first impression perspective?
Do you know why we wear ties? To signify seriousness of purpose. Ours is not to question why, but to do.
Now, you want to dress for success as perception becomes reality and err on the side of being a bit more conservative. Now, when I've raised money and I visit client offices, I usually wear a tie and I ask the dude at the front desk if people wear ties in the office. If not, I take it off. Side note, if you think you're up for promotion, I want you to dress the way someone one level above you would, because perception becomes reality. Now, when it comes to selling over Zoom, a good Zoom setup will do more for your career than an Italian suit will, okay? And in the description of this video are links to lights and audio equipment. I don't get any affiliate fees. Now, when selling, there must be a sense of urgency, meaning you have a limited amount of time to buy. And if you don't buy, there's FOMO, meaning fear of missing out, as we say in Canada where I grew up. And this is why many IPOs do well, because there's a limited amount of time that investors have to buy an IPO at a discount when the investment bankers take the company going public on the roadshow. Now, for hedge funds and mutual funds, not participating in an IPO that spikes on day one is terrifying for them from a FOMO perspective, as they can get fired if they underperform a benchmark like the S&P 500. Now, what materials should you bring to a sales meeting?
I have to evaluate risk, reward, return. That's it. And to that end, my people have a few questions.
How does an idea turn into an investment at your shop?
So in the binder, you want to include your pitch deck, of course, and sample investment write-ups. And you want to include the resumes of everybody on the investment team and use the Harvard Business School one-page format, 2/3 of HBS is BS. Sorry. You also want to discuss gross, net, and beta exposure. Now, what other questions does Axe get when raising money?
I don't get to think about business in such an esoteric manner.
Your Sharpe ratio is very low.
So the Sharpe ratio tells you how much extra money an investment makes for every unit of risk they take. So think of it like this. 2 investments can earn the same return, but the one that jumps up and down less is safer, and the Sharpe ratio actually rewards that. And so volatility in finance means risk, and volatility is also sort of known as a standard deviation. So the formula for the Sharpe ratio is the return on the investment minus the risk-free rate, meaning the lowest risk return on the planet, which is the government interest rate, divided by the standard deviation of the investment, meaning how volatile the investment is. And a higher Sharpe ratio is good. A Sharpe ratio of 1 is decent, it's good. A Sharpe ratio of 2 is very good, and a Sharpe ratio of 3 is excellent and very rare. And a Sharpe ratio of close to 0 or negative is bad. And 0.6 to 0.8 is commonly cited as the average Sharpe ratio for hedge funds. And Renaissance Medallion Fund had an average Sharpe ratio of around 2. Amazing. And this is based on a mean return of 44% and annualized volatility of 21%. So where do you get the risk-free rate from? Well, the very last company, so to speak, that would ever go bankrupt in the world is the US government. And the risk-free rate is often the 3-month T-bill, which is extremely liquid. Now, how do we get this number? Well, I'll do this quick. We go to treasury.gov, then we select data, then daily treasury par yield curve rates. Then we select the current month and apply, and here we see the current risk-free rate. Now, how does Axe answer the answer of the Sharpe ratio question?
I'm sharp enough, but when I'm making decisions for you as well as me, that's when I'm twice as careful, twice as focused, because I cannot live with losing somebody else's money.
Have you had your Carter Staley meeting yet? Is he allocating to you?
Now, psychology is involved when selling because investors don't want to be the first one. They're lemmings, and they follow other investors, and Axe's right-hand man Wags said it best right here.
First money in, gets the party started, entices other investors, all that.
And investors want to invest if others invest. So before going on your roadshow to raise money, it really helps if you have a well-known person or entity that is already investing in you. And IPOs are like this too. Investors don't want to invest unless the IPO is oversubscribed and you have to get in fast, meaning there is FOMO or fear of missing out. Now, on a serious note, investors often ask if your family's investing, as this is the real test if you're putting everything on the line. For example, is Bobby Axelrod's mother investing?
Bobby Mother. I'm Bobby Mom.
I'm 7.5. Sorry. Now, of course, raising money comes down to past performance too.
Here's how simple it is. I've outperformed the S&P by 38.7% over the past 15 years.
So when it comes to past performance, investors want to know how you did in really bad months, like when the market was down in Q1 of 2020 with COVID, or the second half of 2008 when we were within 24 hours of bank machines not working. Now there's also the concept of alpha, which means how much you outperformed a benchmark like the S&P 500 by. So if the S&P is up 10% and your hedge fund is up 11%, you generated 1% or 100 basis points of alpha. Now, if you're just starting any company or a hedge fund, only raise money initially from high net worth investors because the sales cycle is shorter. Otherwise, you will get this response from institutional prospects.
The issue is the turmoil, but the growth that you will have missed out on, that's going to eat you from the inside.
In a year's time, I'd be happy to revisit.
So for those of you starting a tech company, for example, if you want to get venture capital money and you just started, don't waste your time talking to VCs or big institutional investors unless you have had past exits or a stellar track record. You're wasting your time. And raising money is a numbers game like dating. If you ask 100 hotties out and the 101st says yes, then the 100 failures was worth it, right? And don't forget what Michael Jordan said. I failed over and over again in my life, and that's why I succeed. And Mark Cuban also said that you only need to be right in business one time.
Another whiff.
Yep.
It's that easy, you know they're not coming in.
Nope. Just there for the story.
And in a second, I'm going to show you how to download this free book of mine for free, which is going to help you to sell. And here are some excerpts from that book. Lesson number 1 of 49. Always bond before business and talk about what you have in common with the person before selling.
You're driven the way only someone brought up from nothing the way we were can be. Chuck Rhodes, he can never need it the way we do. But the guy's had a safety net all his life. You and me, we never had a net.
And once you bond with them, think about how you can help them with their career. And in interviews and informational meetings or any meetings in business, people are usually motivated by one of three things. Number 1, they want to make money. Number 2, they want to get promoted. And number 3, they want to enjoy the people they work with. And so lesson number 2 out of 49 is help them with their careers ethically, of course.
An ability to help your family. Your mom, she won't have to work so hard. Everyone wants to be a lion. Most people just never get the chance. I'm offering you one now.
And now lesson number 34 of 49 is all I heard was not no. Keep selling until you hear no.
I didn't hear no.
Now, please see the link in the description to download my sales book for free. Now, let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did a superb job of showing how a capital raise and a roadshow works for a hedge fund and how many investors cut or cancel their orders at the last second. The episode also did a great job of showing the process of how star portfolio managers quit to start their own funds. However, the episode was unrealistic in that Taylor would not be able to quit and take existing investors and employees, especially since top hedge funds make employees sign NDAs and massive legal contracts. Also, the part about the Russian mafia wanting to unethically solve Axe's personnel issue is great drama, but not realistic. As a result, I'm going to give this episode a hold rating. Please like, comment, and subscribe, and I will see you in my next reaction video, which is Billions Season 4, Episode 1. I've now completed 36 Billions review videos for the 12 episodes per year for Seasons 1, 2, and 3. I hope you enjoy watching these as much as I do creating them, and thank you.